Inflation hit another 40-year high last month.
Consumer price index up 7.9%.
This morning, new inflation numbers confirming the struggle facing millions of Americans.
Everybody's talking about inflation as prices, especially gas, continue to rise. But this isn't the first time that the US has dealt with very serious inflation issues, so I thought I'd take a look back at the last time this happened and the tough choices that the US will have to make to get itself under control and back on track. So what exactly is stagflation? Well, stagflation is a period of high inflation combined with a stagnation of economic output and high unemployment. So in other words, rising prices and expenses without increased production and a lot of people out of work. So imagine today that you owned a small business, and just like today, gas prices shot up through the roof. It used to cost your workers about $30 a week for their commute, and now that's up to $80 a week. Now your workers need more money just to show up, so their wages have to rise. And on top of this, all of the products that you sell also become more expensive just to ship to your store. So now as a business, you have to deal with increasing wages, increasing costs of goods, and you aren't making more revenue. Just to maintain profitability or at least minimize losses, you might have to lay off workers or raise your prices to cover the costs if your business can even afford to do that. This is how inflation hurts the economy. Stagflation, though, is a slightly different concept. For a long time, a lot of leading economists actually believed that something like this was impossible. They believed that employment and inflation were inversely related. The thinking was that when unemployment is low, businesses will have to pay more to attract employees, which drives up wages and thus inflation. There's actually a lot of areas in the US that have been experiencing this lately if you've been paying attention, especially those in lower paying service jobs desperately trying to attract workers. When unemployment is high, there's a much larger pool of potential employees to select from, so businesses don't have to compete as much for these same workers, and we don't see as much inflation. And actually, long-term, inflation is something that central banks aim for. And this is all because economies seem to handle low or slow inflation pretty well over long periods of time. But when deflation occurs, major problems follow, especially around things purchased with debt. We saw a little bit of what deflation looked like in 2008 when all of these subprime mortgages, meaning mortgages given to those without great credit, started to default and housing prices fell. Without getting too far into the details, many of those who borrowed for their mortgage to buy their house now owed more on the house than what it was worth. So if they lost their job and they couldn't afford to make payments anymore, they couldn't even sell their house to cover the loan. But during the 1970s in the US, all of these economists who believed the philosophic arguments about stagflation being impossible were proven wrong.
So we won't have enough gas to forget it. We'll have to cut the line short.
We are engaged in a long and hard fight against inflation. But if this Congress cooperates in our efforts to hold down the cost of government, we shall win our fight to hold down the cost of living for the American people.
In 1971, the US was experiencing relatively high unemployment at the time at around 5 to 6%, and inflation was around 6% as well. Nixon made some pretty shocking moves to combat inflation. He basically tried to stop inflation through brute force. First, in August of 1971, Richard Nixon implemented what was called the Wage Price and Control Program. Nixon signed Executive Order 11615 imposing a 90-day freeze on wages and price control to combat inflation.
I am today ordering a freeze on all prices and wages throughout the United States for a period of 90 days.
This meant that over the next 90 days, nobody could increase prices, rents, wages, or salaries. Nixon was trying to stop inflation by just telling people, stop raising your prices. Fast forward to October of 1973, OPEC, or the Organization of Arab Petroleum Exporting Countries led by Saudi Arabia, put in place an oil embargo against the US, Canada, Japan, the UK, and the Netherlands for their support of Israel during the Yom Kippur War against Egypt. And the timing of this was really tough. This came at a time when the US had been building out the interstate highway system and Americans had been moving to the suburbs and commuting to work. American oil consumption had been increasing by a lot, going from somewhere between 6.5 to 9.8 million barrels per day. It was quickly outpacing the amount of new oil supplies coming to the market, and this gave a lot of power to the OPEC countries that produce a lot of the global oil supply. The US was depending more on global oil imports, reaching 1.3 million barrels a day of the 9.8 million barrels per day being consumed. The historical charts show just how impactful this was for the US. The price of crude went from $3.50 in the summer of 1973 to over $10 a barrel by 1974. But the price of crude didn't just stop increasing once the embargo was lifted in March of 1974. it actually continued. And then during the Iranian Revolution in 1978, the world lost about 4.8 million barrels per day, which was about 7% of the world's production. During the 1970s, the Federal Reserve was focused on doing everything that it could to get unemployment down. They focused on making loans easier to obtain by keeping interest rates low and making it easier for banks and lenders to loan people money. And these massive oil price shocks, high inflation, and slow growth made it really hard for the Federal Reserve, which was focused on keeping unemployment as low as possible, to raise interest rates, which would make it even harder for businesses and citizens to obtain money as prices continued to rise. The stagflation would go on until 1979, when President Jimmy Carter nominated Paul Volcker to take over as chairman of the Federal Reserve. Inflation had continued to increase during the decade and was well over 7% by January of 1979. At Volcker's confirmation hearing, he laid out the plan to combat stagflation. He pledged to make inflation reduction his top priority, that the country wasn't suffering from a shortage of money. Volcker started to increase interest rates, which began to increase unemployment, making the White House very nervous. Things became very difficult for businesses. The country was pushed towards a recession, the jobless rates were increasing, and businesses were having issues obtaining cash. The country reacted very negatively to this. Farmers started to protest, car dealerships were mailing in coffins full of car keys of all the vehicles that they couldn't sell, and people were mailing Volcker telling him how they'd been saving for years to purchase a house, and they no longer could because the interest rates had been jacked up so much. Carter ended up losing re-election, and then Congress was threatening to impeach Volcker. Things were getting very ugly for the Fed chairman. But Volcker refused to budge, and by the summer of 1982, data was showing the recession had bottomed out. Volcker announced that he would back off of his previous targets and that a recovery in the second half of 1982 was highly likely. At this point, inflation had been mostly over 5% since 1970, and it was finally falling. Inflation had dropped to 3.7%, and unemployment, which had peaked at 10% by 1982, would see a steady decline. So while Nixon tried some, I would say, interesting methods to stop inflation by ordering nobody could raise prices, it just wasn't effective at all, and the only resolution was to rip off the band-aid and start increasing interest rates to decrease the amount of money in circulation. Now, when we look at today's situation, inflation is up by a lot, especially relative to what we've seen since the last inflation crisis. Now, there are a lot of things that are causing inflation to rise, or at least blamed. The most obvious is being all the supply chain disruptions we saw during COVID, oil prices rising, and fears about World War III happening in Europe. But I think that there's a much more obvious and direct explanation here. When the US was hit with the pandemic in March 2020, businesses had to shut down to stop the spread, and people just stopped going out and spending money. This had all sorts of massive impacts that I'm sure you're all well aware of by now. So the response by Jerome Powell and the Fed was to make it easier to obtain loans by dropping interest rates to give businesses a lifeline to stay alive. They said they would keep interest rates near zero until they were confident that the economy had weathered the recent events and was on track to achieve maximum employment and price stability. And obviously, these relaxed policies led to an increase in the money supply. Between 2020 and 2022, the money supply doubled or tripled depending on what method of measurement you use, which makes it pretty unsurprising that at this point we're seeing such high inflation. Now, the Fed is planning to go after inflation this year. One of the hesitations Jerome Powell has blamed towards taking action is that they didn't expect during March 2020 that by January 2022 we would still see record case levels, and that we needed to move past Omicron before we could take action. Things are expected to get much worse before they get better. The February Consumer Price Index showed inflation was all the way up to 7.9%, and with the surge in oil prices in March 2022, that number may come in as high as 9% for the month. The Fed is currently estimating that by December of 2022, inflation would fall to 2.6%, but it would be prepared to adjust if inflation remains higher. The current expectations are for rate hikes to come this year, starting off with 0.25% worth of interest rate hikes, potentially coming as early as this month. And this hike should be the first of several increases this year, depending on how things go. But keep in mind that while there's been a lot of talk about stagflation, the current situation is very different from what we saw in 1970. The 70s saw a sustained period of high inflation without much economic growth at all, and the Federal Reserve really poorly managed inflation by failing to increase interest rates over those years. Today we have seen a year of sharp inflation, but it seems like output is still increasing due to our high GDP growth. Our Fed chair has been slow to raise interest rates due to COVID, but it seems like at least for now we are getting past that and interest rate hikes are coming that should get control of the situation. But as these rate hikes start, we should expect and prepare for some of the pain as businesses have to adjust to having less access to cash. This probably means that unemployment is going to increase, so expect to see those headlines as rate hikes ramp up. This will also impact stock market valuations because businesses that have behaved like bonds growing at 2 to 5% per year become less attractive if you can buy a 10-year treasury bond for the same guaranteed return. I would avoid investing in businesses with high debt situations, especially ones with low growth prospects and products that require a lot of financial investment. If stocks do fall or remain flat over the next year, remember why you decided to invest in that company and pay more attention to how the business is actually performing, not the stock price. Sometimes the stock market gets really pessimistic from time to time, and it creates fantastic buying opportunities. So don't let the short-term pessimism trick you into thinking that you made a bad investment. And as always, thanks for watching.